ICICI Bank announced its Q2 results this weekend, and the numbers have come in much stronger than anticipated by our poll. Let's take you through it. Let's try and break it down for you. The net interest income number has come in at 11,690 crores, which is a growth of almost 25% versus what we projected at 20% year-on-year growth. If you look at it on a sequential basis as well, the growth is strong, almost 6.9% growth in NII sequentially versus the projected 2.8% basis our poll. If you look at pre-provisioning operating profit, it's come in at around 9,900 crores versus our projected 9,400 crore estimate. That's a growth of around 20% on a year-on-year basis. Again, extremely strong number there. Both the NII as well as the pre-provisioning operating profit from ICICI Bank. If you look at gross and net NPAs, the asset quality has improved dramatically. Gross NPAs have come in at 4.82% in Q2 versus 5.6% in Q1, and the net NPA number has come in at around 0.99% versus a 1.16%, a 17 bips improvement in net NPAs. NIMs have come in absolutely flat, around 4% improvement, or at 4% is the NIMs number which has come in Q2, which is 11 bips improvement, a good number there as well. And PAT, which was expected to come in at 5,100 odd crores, has come in at 5,500 crores, a 30% year-on-year jump and almost 19.5% sequential jump there in profit after tax. The capital adequacy ratio stands at 19.5% at the end of Q2, showing good adequacy and good room for growth for ICICI Bank. When you look at the CASA ratio, it's currently at 44%. Deposits have grown around 5.5% on a sequential basis and 17.5% on a year-on-year basis, while advances also grew around 17% on a year-on-year basis. So ICICI Bank currently leads the industry credit growth, and it is expected to do so for Q2 and for the next couple of quarters going forward. Credit risk in large companies could cause chunky slippages for the bank. The cards business performance came in strong. Growth and NIMs, both which were expected steady, have actually outpaced the expectation by quite a margin, and there is a strong uptick in growth. When we look at what some of the brokerage houses have been saying about ICICI Bank, the commentary therein is extremely strong as well. CLSA has upped its target price on ICICI Bank from 1,000 to 1,100 rupees a share, so a 10% increase there itself. And given that Q2 was an extremely strong quarter for the bank, that kind of underlines what CLSA calls ICICI Bank being the best in class in the sector. It also says that the gross slippage, according to CLSA, has moderated, and the net slippage, which came in at less than 100 crore rupees in this particular quarter, was negligible given the high recovery rate which the bank clocked. The bank is now consistently delivering the best growth in the industry. Moving on to Jefferies. Jefferies too has a buy rating on the bank. 1,000 rupees a share is the target price, and believes that Q2 FY22 results were both impressive on the loan growth as well as the wider NIMs front. It sees the bank gaining from the ramp up of the SME and the business banking book, and noted that COVID restructuring and slippages at ICICI are below even HDFC Bank. So overall, looking at extremely strong numbers for ICICI Bank.